I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome back to the show. Today, we've got Tony Lopes, who is a first-generation American. He's the CEO of Dirty Boots Capital. He's also a real estate professional and best-selling author, coach, and speaker. He's got a pretty robust background managing multi-million-dollar programs, but he's also built a pretty substantial residential portfolio as well. And he is here to talk about what we're looking at in terms of what's going to happen in 2025. Is the election going to change things? What's on the outlook? So really appreciate you joining. Thanks again.
Yeah, this is going to be a lot of fun, Hunter. I'm looking forward to wherever this conversation goes. I mean, we started going at it right before you hit the record button, and I'm already like super excited. The goal here is always to deliver value to your viewers, to your listeners. We want to deliver as much value as possible in these recordings. So let's get at it.
Cool. So let's start out by that. You were someone that was not in the real estate business, like most people. Then all of a sudden you are, and now you're, doing quite well, which is awesome to see. How did you make that transition? Did you start out by becoming a partner with someone? Did you start out by raising money? Did you start on the asset management side of things? Would love to see how you were able to add value and therefore get your first deal done.
Yeah, that's a great question. So for me, it started out really as a means of necessity. And so it started really when I got laid off from the commercial world. As I share this story, I share it a lot of times. It's, I came from a background where my parents were immigrants to this country, so I'm first generation. They came from a poor country with little to no opportunity, and so they basically handed down the tablets of go to school, get a great education, you'll get a great job, and you'll be taken care of for the rest of your life. Those were the tablets they handed down, and it sounds great, and it's probably something a lot of your viewers and your listeners, can resonate with. And so for me, that's what I did. I went to school, I got a great education, I got a great job, and then I got laid off. And I was like, wait a minute, that was nowhere in the script. It was supposed to be life happily ever after, right? And so at that point, I wasn't financially independent. I was in my, mid 20s. I wasn't financially independent. I had to pay my mortgage, had to pay my car, all that sort of stuff, like everybody else. And so I had to find another job, which I did. But very shortly thereafter, I bought my first multifamily, right? My very own. I cobbled together the down payment through a HELOC and through some savings I had. That's how I started. And so I bought a quad, a 4-unit building, and self-managed. And that taught me so much in terms of investing in real estate and managing real estate as well, right? So today, when I look to partner with others, that's really one thing I look for in terms of partnering with somebody else. What sort of experience do they have? Have they invested in themselves, buying their own multifamily to kind of, cut their teeth on learning how to deal with tenants, how to deal with contractors, how to deal with issues, all that sort of stuff. Because, I think it's pretty important to, invest in yourself in that way and be able to, bring some value to the table as a partner.
I agree. Offline, we were talking about, I focused on the capital raising side of things. That's just my skill set. It became my background because I was interested in it. You had like a different path and a different way that you kind of went about things. I'd love to learn more about that. And then when you felt that inclination towards, your skill set.
Yeah, I get the question, quite a bit from folks in terms of, folks who want to be a syndicator, who want to start buying big, multifamily type buildings or different commercial property, kind of like the how did you do it kind of a thing. And I think guys like you and me and others who are in that realm, we don't do it alone. We can't do it alone. We need partners. We need a team around us. And so what I quickly realized was I brought with me immense value in terms of property management, in terms of construction management, right? I have a very good background in that. So, there's other folks who, like yourself, excellent capital raisers. That's not really my niche. I don't really thrive on raising capital. So there's other people on the team, who do great capital raising, right? There's other folks who are great underwriters. They're just excellent spreadsheet jockeys, and they're great at that. So the thing I share with folks, if you want to get into like the syndication and partnering game, know the value that you bring. And it doesn't have to be, everything. Just know what you bring to the table that's of immense value to another partner.
Totally. What was it about the project management, asset management side of things that kind of got your attention, or where you uncovered it was your in more in your wheelhouse?
Yeah, so ever since a young age, I just loved anything mechanical, electrical. I was the geeky kid who at, 10 years old was taking apart radios and putting them back together and all that sort of stuff. I have a mechanical engineering degree. So that's what I got my bachelor's in. So that right there, shows you, anything mechanical, electrical, systems, heating systems, boilers, construction, putting, additions onto buildings, dealing with foundation issues. And I mean, that I just thrive on that. That's the sort of stuff that I love. And, one of the things I discovered early, I would deal with contractors and they would say, "Hey, Tony, this is how we're going to fix it." And I'd draw from my mechanical engineering perspective and just my knowledge base. And I would look at it and I would say, I don't think that's the best way to do it. That's not gonna, stand up to the test of time, or that's not the most cost efficient, or whatever it is. And so that's really, my background and why I thrive on that project management, that construction background, that property management background. That's where it really comes from.
Makes sense. And what is your current like investment strategy? What are the kind of deals that you're looking at right now? What are you most excited about? Tell me more about that.
Yeah, that's a great question. One of the things we talk with, just educating folks out there, investors and others, is this terminology of distressed, right? There's a lot of negativity coming out about commercial real estate is distressed and people are too highly leveraged and different things that are coming out. And maybe it's the next crash, the next housing crash is going to be a result of this highly levered industry. And I share with folks, you know, distress is broken into two categories. It's distressed asset and distressed operator. And so in the past, we've seen distressed assets, people who have purchased an asset, they bought it wrong, they paid too much money, they didn't do the bridge loan on it, whatever it was, and it fell into disrepair, and the value add portion wasn't completed. Whatever it was, now the asset is distressed, right? They have poor tenants in there, whatever it is, the asset is in a bad place, right? The other aspect is the asset's fine. It's a good asset, it's in a good location, a growing market with jobs and technology and all great stuff, right? But the operators themselves are distressed.
Hmm.
They may be great people, love to have them as a neighbor, but truth be told, there's been a lot of new operators come into the business over the last, 5, 10 years who really don't have the experience in terms of managing a multifamily, right? Many units and dealing with how do I execute a value add? If I put $4 million of a value add into a building, what should my ROI be? Like, what should I be looking for? So this is where we start to talk about and actually look for distressed operators who really have a good asset. They just don't know how to manage it and they want to exit. And so that's a type of property we like because it's a good property. We just come in and we can just we're excellent in terms of executing, being good operators, being good to the tenants, and just being good to our investors as well. So that's what we're looking for is really distressed operator situations. We'll look at anything out there. I mean, if we find a property that's distressed in terms of needing some value add, we'll obviously look at that as well. But we're finding more distressed operator situations out there.
I like buying distressed deals as well. But the problem sometimes is that people are only selling because they're distressed, meaning that they don't want to sell unless they absolutely have to. And so we've seen this where transaction volume now has just fallen off a cliff. In your niche, in your strategy, in your market or markets, what is the deal flow looking like? Like, give me an idea of how many deals you did in the last 12 months. What's the next 12 months going to look like? Because I think anyone listening to this is like, I want to buy those deals too. But it's like, where are they? So, love to learn more.
Yeah, so off market,
Okay.
that's where we're looking.
Yeah.
That's really where it's coming from. And again, relating back to being syndicators and building our team, we have a partner who is actually a family office out of New Jersey that is just a master with a capital M, a master at finding and having relationships to find off-market deals, right? And so that's where we're leveraging our partners, right? Where they have these great relationships, but in terms of looking at the property, that's where they call me and they'll be like, "Hey, let's go down, let's look at it," and we go from there with seeing if it's worthwhile or not. But that's really what we're leveraging there is just looking for off-market properties and trying to help people. I mean, we're not trying to hurt or kill other investors or other syndicators, but they're obviously looking to exit. And if we can help them, help their investors, and be fair, we're good with that. We're not looking to hurt anybody in this field.
Yeah. Super interesting. And can you remind me, I don't know if you told me, what markets are you looking in?
So primarily Florida. We love
Okay.
Florida. When a state has 1,200 people a day moving into it, you can't ignore that, right? We like Texas as well, a little less. There's some areas that, right, Texas is a big state, huge state, but Austin in particular has seen some pullback in terms of rents.
Yes.
So that's providing some distress in
Mhm.
in in that location. So
For
there
sure.
may be some opportunities there. But for folks who are listening and watching this, all real estate is local. So if I'm looking in Florida, that doesn't mean everybody needs to look in Florida. Look in your own. I'm fine if you want to look in Florida. There's plenty of, deals for all of us. But if you're in Cincinnati, and the Cincinnati market, look in Cincinnati. That's your base. That's what you know. You're knowing how that's growing. You're seeing new industry come in. You're seeing new building projects go up. You're gonna know Cincinnati so much better than I ever will, right? So all real estate is local. So, I would share with folks, look in your own local market and see if there's any good deals there.
Super interesting. What about your perspective on debt? Obviously, you mentioned some of the conversations regarding the bridge debt and floating rate debt, and now that's causing some distress. Where do you stand now? Did you do any of those types of deals, or are you strictly on the fixed rate deals? Would love to hear, the last 2 years and then also like the next 5 years.
Yeah, so we don't like to be too highly leveraged. We look to carry maybe 55%
Okay.
debt on a property. But again, it's a case by case basis. The last deal we did, I think it was 50%. We brought with us 50% of the equity, and so the other 50% was debt.
Okay.
But it was fixed rate debt that was rolled over from the previous owner.
Okay.
So we got fixed rate debt for, I think we're on a note for another 6 years in the threes, 3 point something, which is fantastic on a multifamily. Huge, 153 units, fixed rate debt for another 6 years at 3 point something percent. I mean, we're just going to wait for the market to do its thing and, then either exit before that goes away, or we'll refinance at some point that makes sense. Um,
Interesting.
so, so
What was
yeah.
the story there? Because obviously that's a really good capital stack, pretty much no matter how you cut it up, if you got that. So what was the story? Why was the seller selling? That loan is so valuable.
Yeah, so that was an off-market deal.
Yeah, sounds like it.
And yeah, it was a family that owned the property. Super interesting deal. They had over time built up this multifamily complex, really. They started with, I think it was a duplex,
Hmm.
and they had all the land around it. And so they built 12 units, a few years later. And then a few years later, they built another 12 units and then another 12 units. And so it turned into this great complex with 153 units.
Wow.
It was vintage. It was 1970s vintage, right? So a lot of opportunity for value add, but it was basically a mom and pop operation that, didn't really know nice people, but didn't really know how to take it to the next level, and do that value add and determine, what should the rents be? If I'm going to put, 4 million bucks into this, what should the rents be on the other side of it? Or should I even put some capex into this building, right? The Florida market is crazy. Sometimes all you need to do is new floors and new paint, and you can raise the rents 200 bucks. I mean, it's all case by case. But this was just a fantastic deal where we just went in and took over this off-market property and just rolled over the debt into our name, and it just worked out beautifully.
And what's your vision going forward? Obviously, off-market deals are great when you can get them. Sometimes it's hard for volume. There was a moment where the off-market thing was basically in my market in Phoenix. There was like no off-market deals because there were so few transactions. No one would want to put their deal out there without having a full process because you wouldn't really know where the market was without doing that. Now it's not so much the case. But I anticipate that if we continue to see rates lower, we're probably going to see valuations pop because people will feel like, okay, this is the direction things are going. We've reached the bottom. We saw this in a couple of deals where there was certainly some sense of FOMO. Like, if we don't get the deal now, like, we may never get it at this price again. That's subsided to some degree, but if there's a couple more rate reductions, it might come back in a big way. My view is that if that does happen, if those properties that we were bidding on for 20 million start getting sold for 25 million, that's going to create some comps where there's a lot of sellers probably at the 25 million mark, all things being equal. So transaction volume will start to pick up dramatically. But that's just Phoenix. What's your view on that? I'd love to hear more about your perspective.
Yeah, no, that's a super interesting question. It's something we all wrestle with, right? Where's the market going? How do we position? What's our strategy? And I'll share, our strategy is to, buy as large a property as we can. 150 units is really the sweet spot, because what ends up happening is, yeah, if the price of things does go up, because rates come down. That's just how it works. We need to be able to find some efficiencies to make the property work. And when we have, like, say, 150 units, we have this, as you know, economies of scale, where we can have on-site leasing office, we can have on-site property management. When we do certain construction projects over 153 units, we can get the cost down. So really the goal is to, right, you can't do that on, say, a 20 unit building. You're just not going to achieve those economies of scale to be able to make the finances work, right? It's just math. This is just a math problem we're trying to solve. And so with many more units, we can make that math problem, work in our favor. And so that's our strategy. That's what we're looking at going forward.
Okay, makes sense. What would be something that you would be super weary of? Is there any bearish signals that would make you pause, stop buying, maybe even stop underwriting for God's sake? Is there anything on the horizon that you're seeing as potentially a challenge there?
It- what? No. Maybe if I thought long and hard enough, there would be, certain things. But we're in, actually today we're recording this. This is election day for the entire country, deciding who's going to be the next president of the United States. And I'm listening to both sides, and they're both talking about putting foreign tariffs on foreign supply coming into this country. So if they're both talking about that, the cost of things coming into this country is just going to increase, right? Because of those tariffs. And as a result, things like everything from appliances to building products, all that stuff is going to get, to be more expensive. So I look at the way things are today, And like a lot of folks in the business of investing in real estate, we're kind of all like on a buying spree because we're looking into this windshield and we just see things getting worse in terms of
Hmm.
the cost of building and maintaining properties. So yeah, there's a lot of us who are just like not 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 doing stupid, right? We don't want to pay more than a building is worth, but at the same point, uh we're just very wary of the future from the standpoint of the inflation of goods because of, for one example, these tariffs on foreign products.
Hmm. Interesting. Yeah, it's obviously there's these massive tailwinds, the renter nation element you mentioned. That's like something that's not going anywhere. The demand for affordable housing, that's something that's not going anywhere. But there can be unique challenges that create problems, and obviously interest rates are one of those, right? Like we saw that you still have the massive demand for the product, you still had a supply and demand imbalance, but then interest rates move faster than they've risen in 40 years. And hey, guess what? That will put distress on any financial asset, essentially. Um, Other than that kind of financial risk, though, um, when it comes to like things, you mentioned Florida, you got hurricane risk and insurance risk, and I'm sure you've seen those products increase dramatically. Even in Phoenix,
Yeah.
we've seen one of our properties went from $300 a door, something like that, to $800 a door because the insurer we had got out of the business because they're no longer lending on 70s vintage product. Now we've got plenty of room in that deal. That's not going to be a problem. I mean, we're lucky to say that for a lot of reasons. We've been working hard to make that the case, but that is true. Most properties can't live with a 3x increase in insurance costs. What is your view in terms of that particular risk? I know that's something that you probably put a lot of thought into.
Yeah, that's a great question. We get that a lot from investors too. Because yeah, Florida, we just got hit by Hurricane Milton, just ran right through the entire state of Florida. It's amazing the amount of damage that was done down here. But I'm down here. I see it firsthand. And we're very particular about the types of buildings we buy, right? We only buy concrete block, right? We don't want any stick built buildings. So that's one thing we do to hedge our bets and work
Mhm.
with insurance companies to say, hey, let's get those rates down because it is concrete block, concrete reinforced, it's not stick built, low probability of damage, things like that. The other thing we look at is when we look at a property, even though a roof may not, be end of life and need to be replaced, we may just replace it anyway as part of our CapEx because then we can do all the correct supports and trusses and hurricane hangers and upgrade that roofing structure so that it complies to today's standards and so that our insurance rates come down, right? So those are two things we do specifically to work to manage the insurance cost that's been going up. We also build it into our pro formers when we negotiate the deal because the pro formas are interesting. Sometimes you look at them and you only see the income go up on a pro forma, and you really have to push back and say, hey, your expenses are going to go up too. Insurance is going to go up, say 8% of the 8% a year. Your property tax is going to go up some, right?
Right.
So we do. That's all part of our negotiation to make sure we get the best deal for investors.
Yep. Yeah, it's interesting. It's just most people aren't underwriting to a 3x increase, you know what I'm saying? And especially not in an area that
Yeah.
doesn't deal with that stuff. So if you're listening to this, I mean, obviously, most of the listeners out there, if you're in the capital raising side of things, most people are in multifamily because that's the darling of all of private equity. Some people aren't, but you get my point. Within that kind of Venn diagram, a lot of people are buying 70s and 80s properties. And so just be careful about the fact that some insurance companies are bouncing out of those 60s and 70s products, maybe only doing 80s or newer, and some are doing 90s or newer. Even if you're in a market that doesn't have those natural disasters, because we just saw it in Phoenix, just something, it's going to be in this case, at this moment of the cycle, it's a huge negotiation tactic when you go to put in offers on a property because you want to be able to be conservative. You don't want to start your buy, get a new insurance product that is way out of pro forma, and now you've got to try to chase it and make up for it with other NOI generating activities. So not the best way to do it. Okay, I want to transition. Is it okay if I transition? We talked a little bit about real estate. I want
Yeah.
to talk about some of the places that you go to get information and motivation. What are some of the data sources you go to, the resources that you have to keep your head in the game, stay, on the edge of the curve, et cetera?
Wow. Social media, certain aspects of social media are great. Not, sometimes you can go to social media and I'm victim of this where you go down a rat's hole with some of these threads. But there's folks who are harvesting data and posting it out there on social media, on X. I particularly I enjoy X because it's more professional. LinkedIn is also more professional. Facebook, Instagram, less so. But those two, LinkedIn and X, are really great places to see what other people are pulling together, and also to be able to network with others and create a bond. I've had many great conversations with folks I met through social media, and we're just trying to help each other understand the market better. Right? None of us have the answer per se, right? We're all trying to figure this out. I don't, my crystal ball broke a long time ago. And so, we're all trying to look in the windshield and all try to figure this out together. Which way is the market going to go? Which way is the interest rates going to go? And so the more of us that are putting our heads together, the stronger we are. So I do lean on social media for some of that stuff. I mean, obviously, CoStar and some of those industry reports. Marcus and Millichap has great reports that they put out. I
Completely
love
agree.
reading their stuff. Um, so we do lean on some of those bigger folks in terms of what they're doing because, let's face it, they have many, many more analysts than I have
Right.
to be able to cultivate, the data and dice it and slice it a bunch of different ways. So if they're going in one direction, there's probably a reason they're going in that direction. So CoStar, Marcus Millichap, those are two that, we do look at frequently.
I actually just did a little exercise where I put one of Marcus and Millichap's national multifamily reports, which they put out quarterly national multifamily reports, which are free. You can go to their website and just download it for free, into Google's AI reader that then it reads any PDF document, could be hundreds of pages, and then creates a concise 15 to 20-minute interview style podcast with a female and a male voice where they go back and forth and talk about the content. So I really do like to read those reports. It's one of the few things that I read regularly. But if you're the kind of person that just likes to listen to podcasts, obviously we're talking on a podcast, that might be a cool way to do it. It takes about an hour or something to consolidate it all. And I was able to do it with my book, by the way. So I just put my book in there and heard some of my people talk about my book. It's pretty remarkable. So that's awesome. And by the way, I think I underutilized X, formerly Twitter, for a long time. When it comes to economic data, it's so fast that you can go there and scroll through and get access to updated information. Like right now, the number one thing most people are focusing on is the first Friday of every month is the jobs report of the former month. And so though the Fed does track a lot of things, that's usually the number one thing that they're looking at to anticipate how healthy the economy is and what direction it's going. So if you're looking at the Fed to kind of clue you in as far as what the next steps are going to be in terms of the lowering or raising of rates, the jobs reports are something you should be paying attention to. So I don't want you to get surprised if the Fed doesn't lower rates as they anticipated. Usually you can front run that a bit by looking at those jobs reports. So that would be one thing that I would always give people the content to go and check out. And of course, we try to keep you all ahead of the curve on this podcast, the Cash Flow Connections Real Estate Podcast. So before we jump off though, hey, listen, I really enjoyed this conversation as always. If you could do me a favor though, let the listeners know how they can learn more about you, your company, etc.
Sure. Thank you, Hunter. I appreciate you for that. Yeah, if they want to learn more about what we do, just go to dirtybootscapital.com. They can see all that I do here and they can reach out to me there. If they want to schedule a one-on-one meeting, just click on the link and let's go ahead and do that. What I would like to offer is to your audience, to your viewers and your listeners, a free copy of my book. If they want a free copy of my book, Freedom at Risk: How to Protect Your Personal and Financial Freedoms, which is super important today. Regardless of who wins the election, our freedoms are at risk and we need to protect them for ourselves and for the next generation. So if you want a free copy of that book, Freedom at Risk, How to Protect Your Personal and Financial Freedom, send me an email at Tony Lopes with an S, Tony Lopes at dirtybootscapital.com, and just put book in the subject and then just give me your details with where to mail it and we'll get out a free copy of that book to you.